I want to share with you a few thoughts on what I think about actuarial capacity. I do not want to just, it would be very interesting to talk about the role of the actuaries and how this fits into the system, particularly how we have implemented in Austria. I want to, because there is a real concern of the question becomes more and more relevant if what Karel wrote the rules, so he says there is an actuarial function. But because it's in the rules, it's not, does not mean that it's there in practice already. And one of the reasons why it is not perfectly implemented might be that there is a lack of capacity. And I want to talk more about that. And that is not only true for this region, but there are in many, many countries. So I want to briefly go through and ask about what is the role, and the actuarial capacity is a key element of insurance. I think Karel already pointed to that. I think the application of sound actuarial principle is a key element of insurance. And I believe, I have to say, I still believe insurance for me is not the type of banking business that some insurers do, in fact. It's really about the core business of insurance. It is what we call traditional, but that was not a good, might be not a good term, but core insurance business. There, I think we have questions of the uncertainty of the event, of claims coming up or not. We have long-term promises. We have the question of probabilities, future cash flows, data availability, data quality, all those type of stuff. So I believe that for all types of insurance, business models and supervisory systems, there is a need to apply sound actuarial principles. Also, through the proportionality principle, there may be, of course, some nuances on that. And I'll come to that later when I talk about the question of what can we do on strengthening actuarial capacity. But it would not only be difficult enough, what we have seen in the past. We see new actuarial challenges in a very fast-changing world. We see products getting increasingly complex. I mean, we try to solve that. We see how difficult it is to solve those issues in the new rules on PRIPS, IDD, on information documents, to make all these complex things to be easily understood, which is quite squaring the circle, I think. Products get more individualized, and certain classes of insurance, certain products can be based more on individual experience you have. MTPL is an example, and health insurance, premiums for accident insurance as well. And there are also these investment type insurance products that are we are very much concerned about, because sometimes they overshadow the need for the actuarial principles in that. So it seems very easy to pack some financial products and wrap them on insurance coverage. That seems everything is well replicated through the asset side, and that sometimes could hide the underlying issues that are of more fundamental nature. And of course, new areas of insurance have emerged to cover cyber risk and so on. I want to come back to a fundamental issue, and that is whether your country a member or not of the European Union. It's not only about the question of fulfilling the Solvency II requirements. Let's just step back and say, what about the insurance core principles that apply to all the members of the IIS? And if you look at that, you see that there are a lot of insurance core principles, particularly, of course, the prudential ones, that can only be met in a reasonable way if some preconditions are met. Because if there is no good legal system, no good court system, if there is no good audit profession, if there's not good actuarial competence there, then that might impact on the question on how you can really observe the different core principles. And then you get downgraded on all of them just because there is a lack of that competence there. And one of those preconditions is, and there's a quote from the ICP paper, availability of skilled, competent, independent, and experienced actuaries. So that means on the one hand, there should be a chance. So one important thing, and I like so many people from academia here, that is a question of education, of course, of training. That's a question of attracting people really at the right places, and particularly for supervisors, and I will come back to that, what particularly the challenges of the supervisors are in that respect. And the compliance of this actual work needs to be there with standards, and they need to be set and enforced by official and professional bodies in line with international standards. And I come back to the question on, so we do not only need actuarial profession, and I'm very much an advocate of international standards also for actuarial profession. For some years I would say, quite frankly, the actuarial profession has lagged behind other professions on that, and that needs to be overcome, and I think it has been overcome to a large extent already. I myself have been involved in the development of the ISAPs, so the International Standards of Actuarial Practice, and which is then translated in the ESAPs for the AAE in the European context. So I think that is really setting the ground for having these standards in place, so that within that standards, the actuarial profession can grow and can present and fulfill this precondition for the insurance core principles. The ICPs, as I said, contain a number of particularly prudential standards that can only be implemented properly when you use appropriate actuarial competence. And I say actuarial competence because there's a difference between actuaries and actuarial competence, and I come back to that. It says also actuarial function, and Carol pointed out to that, because that opens also the door for this, in a more broader global perspective, for a proportionate application of these skills and competencies. The ICPs apply to all jurisdictions. However, supervisors need to tailor certain supervisory requirements in accordance with nature, scale, and complexity of individual insurers of the markets. You know this as the proportionality principle. And that is an interesting area, because that means you can get completely frustrated if you are saying, I look for qualified actuaries before I can start any type of insurance business, before I get to the next step. We all have insurance business here in the region, but it's going step by step to more complex products. The markets mature more and more. So the question is, what do we really need to fulfill those requirements? And if you first say, I can only start after I have 100 qualified actuaries in the country, then it will take decades for sure to be able to do that. So we need to find out what is really needed as concerns the actuarial competence in order to get those markets running. I think I can be very quick on that, because that is not so much different, of course, from what Karel said, but more focused on the supervisory authorities. And here, it's of course important. Solvency II is a system where you have a choice of adapting the parameters and the underlying assumption to your own risk, which is fine, because then it's really risk sensitive. On the other hand, the supervisor need to make sure that this is truly reflecting the risks of the company, and you are not just trying to optimize your capital. So there is a strong need that we are able to assess what the actuaries in the companies, what the actuarial function in the companies is doing on that. SCR, best estimate calculation, is a completely new territory for us, or has been. Now it's getting much, much better. We are getting more and more used to talk about those things where we have 20, 30 flowing parameters, but that is our business, and it has become our business. And you are right, I do not so much agree, and we can talk about the Austrian case later in break, but I think where you are right is that we need to we need to adapt to this new system. We cannot say that we try to keep as much as we can from the old system. It was difficult for me, as you said, after 30 years, to have this kind of more new thinking of how you go about technical provisions. And I come to some of the issues in a minute, which particularly pose the challenges. But in the new world, it was the same in 1995 when we joined European Union. we abolished completely any product control. That was difficult because we did not know anymore, except for life insurance, what is going on in the market. But you have to adapt your tools, not try to prolong the history, which will never work in a new system, but think, how can I go about this? And this is, I have to say, it's developing better than I would have expected. So what are particularly challenging, and I speak from supervisory authorities' perspective, it is hard for the supervisors to keep pace with increasing complexity in business models and products. So the environment is changing very quickly, risks are changing, and I'm an absolute advocate of saying all we do, all our risk assessment frameworks we use in supervisory authorities, the most important thing is that we have to look at them in regular and even always shorter intervals on whether we are really measuring the right things, whether we are looking to the right things. Are there risks emerging which we don't see? We are just measuring, and that would then complete. You have seen the old approach and the new approach that Karel said. So we should not go back to the old approach in the new system and say that's what we have seen, so we have a stable system, we can measure that. We need to challenge that every day. We need to see situation, we need to be aware that results that look implausible may be correct. It may be the case that after applying a shock, the company is better off than before. That might happen. We need to be aware that results that look very plausible may still be incorrect. So we need to have a different approach to that, because in the old days, you would say very easily, if you have 4% of technical provision and you increase technical provisions by 10%, then the 4% will increase by the 10%. So that is no longer the case. We have to do with very different sensitivities on best estimates. So for different companies, changes in different areas would result in hardly any changes in the SCR ratio. For others, it would eat up completely their own funds. So that is a very, we need to be aware of that. And we need to look into that and try to also get an idea of how that is the case. Of course, risk-sensitive systems need to have some complexity in them. The question is how much, and the Solvency II review now is trying to balance that to get out of too much complexity where it's possible without losing too much the risk-based approach, the risk-oriented approach. Under Solvency II, input-output relations are often not linear. In the old days, we were used to have most of the relations were linear. And now we have a lot of things where we have to say small changes, big impact, or big changes, small impact. That it can be the case. Impact of changes can, of course, due to different sensitivities, particularly on the technical provisions. Supervisors need to be able to challenge the underlying assumptions. So we need to form our own view in order to be able to really challenge, not saying this, what you do I think is not correct, because you will, since there is always a range, you will always have difficulties in proving that you are outside of that range. So coming from a certain, we say you take some assumption and then compare to the assumptions of the companies. And supervisors should be able to replicate the insurer's calculation on their own. So to have at least some basic ideas and models available to just be able actively challenge that. If you're in a passive way and they say, this is the figure, Peter BRAUM&Uuml, this is my figure, and I have calculated, and I have 10 qualified actuaries, so you might not challenge that. And still, I need to challenge that. And at the end, I can say it's correct. But then I have challenged that, and this is a result of a in-depth assessment. Finally, I would like to come to an issue which is close to my heart, which is what can we generally do to strengthen capacity in actuarial capacity in insurance companies. And I want to say, I don't like so much that we always distinguish between actuaries and heads of the authority. I think heads of authority should have an idea of actuarial science as well as from the legal environment. So I do not say, we say what do the actuaries help the management, the head of the authority. We don't ask how do lawyers help them and how do economists help them, because obviously we have the idea that people that are taking the decisions are non-actuaries, and we should come away from that. So we need at least some basic understanding also in the management of supervisory authorities on all the different types, including the actuarial. Otherwise, you will not have this, you will break the chain in between the experts and the management decisions, and that is the worst thing could happen. And sometimes, I think Carol can agree, in Solvency II development, this has happened. So there is a kind of dislink between expert development and what you take decisions. But exactly what we want to do is that in Solvency II, the decision-making is based on the underlying system you use, and not this is something different, and you do something completely different. So there are many of those, there were two major initiatives in place. There was a pilot project in July 2017 in China from the IIS and the IA, and that was to try to deliver actuarial competence. It's not, the whole initiatives are not about educating actuaries. That is part of the national and international actuarial associations and other stakeholders. This is about how to strengthen the actuarial capacity in supervisory authorities in a more sustainable way. Sustainable is important because actuaries coming to the authority, I think they have one of the, in my authority, actuaries have one of the most highest turnover quotes because they are, of course, leaving to the industry, then we try to get some back and so on. It has stabilized a little, but still it's a challenge. So we need to strengthen the capacity. As we say, it's a function, it's an actuarial function that should be in the company existing, and even if the function holder changes, the function should remain stable, robust. The same should be in the supervisory authorities. Even if people leave, you should have in place an actuarial system that works well. And there were two main initiatives. The one is the IA-IIS A2II partnership agreement in November 2017, which tries exactly now to, in a structured way, to strengthen the actuarial capacity of insurance supervisors. That is in the context also of developing markets. And this is not only, sometimes this is considered to be only parts of Asia and Latin America and Sub-Saharan Africa. This is, I think, not the case, because this can be translated in different maturity stages of markets. So if you move from one stage, you have many markets here in the region where life insurance is not yet developed so well, or sophisticated products is not so well developed. So if that is going on, you're in a similar situation. And I'm in the same situation if very, very complex cyber insurance coverage comes up to say, what do I do with this product? Is that fine, or is it dangerous, or whatever? So this one. And the second one is a joint project between the IIS and the International Actuarial Association on actuaries and inclusive insurance. And there, the core is that the IIS and the IA will both develop, are in the process of developing papers on guiding supervisors how to establish proportionate prudential approaches to inclusive insurance markets. The question always is, too much regulation, no insurance, because then it's simply too expensive. But on the other hand, if it's too low, then you run the risk of exactly damaging or detrimenting those policyholders who need most their protection, the poor people, the less sophisticated people. So this is a very challenging but very interesting project, because I believe there is a right level of regulation and supervision you can do, that both the insurance business can develop and we continue to maintain the ultimate goal of our job, which is to protect policyholders at the end of the day. Finally, a few conclusions. I believe that the observance of the IIS insurance core principles gives need for adequate actuarial capacities in the market, and particularly also in supervision. Having no actuarial capacity in the market, it makes it impossible, but even if there's actuarial capacity, supervisors are competing with others on the best people, to get, so remains a challenge. The proportionality principle allows less developed markets to take account of their specific circumstances. That also includes actuarial methods for the implementation of prudential standards. We should not lower prudential standards, and I say ICPs go for all the jurisdictions. We should just say what is a more creative, intelligent, innovative way. I think there was innovative in one of the definitions to deal with those circumstances. It is important for supervisors to have sufficient in-house actuarial skills available. I'm a firm believer you should not outsource all these actuarial knowledge to outsiders. We have had not so good experience in the pension area 10, 15 years ago on that. So I think it should be similar what we expect from companies when they outsource. They should have a core capacity to be able to do that. That would be the minimum. But I believe you should be able to rely to a high extent on in-house actuarial skills. Supervisors must be able to challenge actuarial information received from insurance. And that is not just on a formal perspective, but really to the content. I don't understand that. What does it mean? Who is responsible for that? Solvency II implementation requires substantial actuarial resources, no doubt on this. Supervisory authorities are competing with industry, I already mentioned. Actuaries need to be able to work closely and efficiently with other professions, particularly product development and also internal models, but there are many more examples. In order to make informed decisions, senior management of supervisory authorities needs to have a sound understanding of the work of actuaries. So if they are not themselves actuaries, I think they need to at least understand the basics of the actuaries. There's no excuse for that in not doing that. And finally, ISIA and HOI are pursuing important initiatives to strengthen actuarial capacity of insurance supervisors. So I think there is a future for this, and we can be optimistic, but what I wanted to say, it's hard and difficult. But I think we are on a good way. Thank you very much.